The Fed kicking off its two-day FOMC meeting today. The central bank widely expected to hold rates steady. Joining us right now is Goldman Sachs' Vice Chairman, Rob Kaplan. He is a former Dallas Fed president. Good morning to you.
Good morning.
What do you think we are going to hear from this Fed? I doubt they're going to change the policy anytime soon. I imagine it's going to be about what we actually hear from the man himself, but that's probably going to come later tomorrow.
Right.
What are you actually looking for him to say? And will he actually comment on tariffs, you think, for the first time in a meaningful way now?
I think by the way, you're likely to see, you may well see one or two dissents from governors who will argue that they should lower rates. I think you're going to see him be balanced and leave his options open, including the option of acting in September. I think he's going to be careful not to get too deeply into tariffs. And, the fact of the matter is there are a number of disinflationary forces that are going on here. Growth is sluggish. There's a regulatory review, should be disinflationary. We have an AI boom, it should ultimately be disinflationary. You have goods overcapacity around the world. Against that, we'll get more resolution, and we're about to get more resolution on what the tariff rates will be. Those will certainly increase costs. The question is, will it lead to persistent price pressures in a disinflationary environment? And the truth is, for this meeting, I think they're not sure. I wouldn't be sure either, but I think they're going to direct attention to September, and I think you'll see them try to be balanced.
Try to sort of prognosticate a little bit farther out. What is your sense of what that looks like later? So part of the issue, you're right, has been we haven't actually seen the tariffs in a meaningful way. We've also had this issue of all this inventory that was brought forward. Are you a believer that we're going to see some form of inflation or not?
I think you're going to see some cost impact depending on the industry. So that'll mean prices in places will be higher. Having said that, that won't be the question. The question to me will be, can I look through it? Are they likely to be one time? And I think they're going to, if I were in my old seat, I'd be pushing my team to try to come to some judgment on that by the September meeting, which might cause me to act.
Yeah, Robert, you chose your words carefully, and Andrew asked you about inflation, and you said costs. You deliberately, and I understand why you did that. My question would be, it's a dual mandate, but it never seems to me like it's 50-50 in terms of where the real concern is. And I don't think it should be. I'm not even sure it should be dual. And it's always nice to cut rates. We always wish we could have lower debt service. But if you really think price stability is maybe the job one for the Federal Reserve, and a lot of people do, then you wouldn't cut right now. Do you think that they're erring? Do you think right now it's like 70-30? Price stability over full employment?
So the fact is, I think we're at or near full employment. The issue is, it's the reason that unemployment rate is as low as it is not that businesses are hiring aggressively. They're not. It's very sluggish. It's that workforce growth is been decelerating, is lower, and so. I think one of the factors that would affect me is while we're at or near full employment, hiring levels are very sluggish, and I think may continue to be sluggish. And so, no, I think it has been overbalanced recently to inflation as it should be in light of the tariff situation. I think you'll see them try to get more balanced here, which may cause them to act. But again, not until September, in my opinion.
The Journal has a big piece. Last time they cut rates, long rates went up. So it's almost, we get the opposite. That's the last thing you need is
well, they went up for a reason, though. That's a little misleading. A lot of people quote that. So remember
a lot of people do.
What happened. The long rates didn't go up because the Fed cut. Long rates went up because there was a rebound in expectations of the economy. Trump won election. There was a view that growth was going to be much higher. Remember, on January 1st, the expectations for growth were 2.25%, 2.5%. People thought we were going to have a stronger growth environment.
The point is the same. The Fed cut rates, and it's just proof that they don't have control of the long end. The Fed is not all controlling.
That's right. It's a lot more about prospects for future growth as well as supply demand of treasuries.
So then, Rob, actually, can you speak to this? There's this whole sort of, and maybe it's a political sense that, the president's going to put somebody else in this role in May, and that they're going to lower rates, and that by lowering rates, we're going to be able to buy debt at a lot lower prices, and that mortgages and everything else are going to be a lot better. It's not clear to me, given where we are in the, wherever you think we are in our economy, that, as Becky just described, that they can actually control at least the long end of it all.
They can't. The Fed sets the shortest term rate, the Fed funds rate, and the longer end of the curve is much more a function of supply demand of treasuries and prospects for future growth. And you could just as easily see the curve steepen if they cut. Also, the reason the Fed isn't cutting is not because of Jay Powell. The reason the Fed isn't cutting is there's not a consensus around the table that it's time to cut. And there are 12 votes, and he doesn't get to decide on his own. If there was a different Fed chair right now, I think they also would not cut in July. So I think there's more nuance here than maybe is being reflected in the public comments.